Welcome to this evening's presentation, Brave New World, Tax and Investment Changes Affecting Aussie Expats Under the New Trump Administration. I'm Ashley Murphy, the founder and principal of Areté Wealth Strategists Australia, and thank you for spending part of your evening with me as we run through these important topics. So just the first few things to note here is this does not constitute personal financial tax, legal, or investment advice, and it should not be relied on as such. You should really be consulting your own tax or legal consult. If I am your financial advisor, then advice is offered in a private client engagement setting, and this is not one of those situations. I should make you aware of our YouTube channel. Anyone that registers for the event, if you can't make it, please be aware that you will be notified the following day when the recording is up on YouTube. We send this out to everyone that is registered, so that way you don't miss a thing. And including last month's presentation, well, I should say October's presentation, because technically tonight is the November presentation, but last week was Thanksgiving, so we deferred it to this week. But the October presentation, Bridging the Pacific, Crafting Tax-Smart Aussie Estates for US Beneficiaries, really a fantastic topic, something I've been wanting to do for a long time and done in conjunction with a cross-border estate planner. So who are the kinds of clients that we work with? Here's just a brief list of three composites. So the Australian business owner living between the US and Australia, the high net worth family currently living in the US, and the Australian executive and family permanently relocated to the US. There's also other permutations and a lot of folks that we assist in their moves back from the US to Australia. What are the results? Well, essentially, I don't think there's anything more valuable than attaining your goals. That's what it's all about, right? So in the case of the Aussie business owner, that's exactly what they do. Helped him avoid the exit tax in large part because his legal team and accounting team weren't aware that being on a green card and staying beyond 8 years would trigger the change in status for him. So a whole host of other results achieved here that you're welcome to look at on my website if that's of interest to you. A little bit about my background. So born in the UK to an Australian father, American mother, raised in Brisbane, Australia. I'm just laughing there because it turns out that the last meeting I had, well, lo and behold, I went to the same high school as my new client, and so we had many common names that we could reminisce on. So raised in Brisbane, went to the University of Queensland for undergraduate studies, moved to the US in 2005. So it will be 20 years next year that I've lived in the US, but we're moving back to Australia as of January. So we're just shy of 20 years, actually. I am a certified financial planner. I started study towards the Chartered Financial Analyst designation. I'm also the founder of the Global Financial Planning Institute, where we provide instruction to other financial advisors in the complexities of working with clients whose financial lives cross borders. I'm also a regular conference speaker, having recently just spoken at the National XY Planning Network presentation or conference there in October. So tonight, what are we talking about? The focus of tonight is on the following topics, and I've had to be very intentional in how I present the material because this is not a political advertisement of any kind. This is a narrowly focused presentation on those proposals that have been either mentioned or there's maybe a little bit more substance to them, or continuations of prior policies in the case of immigration that are going to affect my addressable target market, that is Australians in America or Americans in Australia. So what are the things that will affect us? And please, by the way, I encourage you, if you have questions, feel free to interject. Just type those into either the chat. Actually, I have to say just the chat because I won't be able to access the Q&A panel with how Zoom is set up. It's not possible to do that while in full screen. So please chat in your questions. So this is what we're looking at. We're looking at the changes in taxes, changes in Social Security, the economy, stock market, federal debt, immigration, and unfortunately, I did not get to the treaty status between Australia and the US. But the takeaway that I have from this, and I don't think I would be the only one in saying this, is that the near term for me and for my clients is mostly good in a very selfish way. I feel guilty about saying that, but it's mostly good. When we look at the long-term financial stability of the US, though, not so good. There are some graphs that I omitted from tonight's presentation because I thought that they would be off topic, but that is my general sense of this. Is that yeah, who doesn't like lower taxes? Who doesn't like more Social Security? But if it's being done in a way that may imperil future generations or the stability of the US, then maybe that's not such a wise choice. Excuse me. So the broad policy agenda of the incoming administration has been outlined as follows. So we're talking about a continuation of the Tax Cuts and Jobs Act, that's the TCJA of 2017, which would keep that marginal tax rate of 37%. We're also looking at keeping the estate tax exemption currently at 13.6 million. That's per person. So a married couple, you can double that. Next year, it's going to be very close actually to 14 million. So $28 million before you have to worry about a 40% estate tax. Corporate tax rates, there's talk of lowering them further. The TCJA brought them from 35%. It's quite a steep decline down to 21%. Talk of lowering that even further. For companies that produce in the US, business tax credits, a proposal to repeal the Inflation Reduction Act. I don't think that will probably happen, given that the majority of dollars that were handed out were actually to red-leaning states and have added a whole number of jobs predominantly in those states. Child tax credit, talking about increasing that further. It's now up to $2,000 per child, but increasing that further to $5,000. There was bluster on the campaign trail about excluding wages and tips from federal income taxation, and also Social Security being excluded from federal income taxation. Of course, we've all heard the headlines about the tariff proposals, where the initial baseline of 10 to 20% would be applied across the board, with China singled out for a 60% tariff increase. And then, of course, we can't help but forget the threat of the deportation of illegal immigrants. I think, just to put some color to this, I think there are many things that were said. There was raw meat thrown to the crowd throughout the campaign, and I just have to think that the deportation of illegal immigrants is not going to happen. I just can't see it. When you read the numbers on the food system in the US, the farm sector, the restaurant sector, the number of people that are undocumented in those industries is incredibly high. And one would only imagine the upheaval that would cause, and the inflation, not to mention the human cost to those affected people, but the economic cost would also be tremendous. So I think this is one where, in fact, as President-elect Trump has been making more appointments, they're now making a finer point to say, well, this is really just of illegal immigrants with a criminal record, or have done something else that they deem undesirable. So I just don't see that actually coming to pass. So in terms of taxes, what are we looking at? We're looking at an extension of the Tax Cuts and Jobs Act. I'll go into details to all of the things that involved from a personal point of view, not so much business point of view. We're looking at changes to business taxes and rates, and then a proposal that what could be huge for this crowd, a proposal to end double taxation for US citizens living abroad. So the Tax Cuts and Jobs Act likely extended. I would be very surprised if it wasn't. This was Trump's handout in the first term, and so it would only make sense that he would continue his own policy. It was one of the first things that he put through was this tax cut. So what does it mean for you and your family? Lower rates and higher estate tax exemptions are probably here to stay, unless they're temporarily extended. Remember The Tax Cuts and Jobs Act consisted of some permanent changes, corporate tax rate, and temporary changes. Those were the personal tax rates. They were only ever to be in existence until the end of 2025. So they were scheduled to sunset at the end of next year. So what are some of these changes? Federal tax rates and brackets. Let's just skip ahead real quick to the next slide. So tax rates and brackets. So prior to the TCJA, you see what these rates were and what they would revert to. So the 12% rate was 15, the 22 was 25, 24 was 28, 32 was 33, 35 was the same, and the 37 was 39.6. So that's what they would revert to should this not occur. So we'll see these lower rates staying around. The standard deduction was doubled in light of the TCJA. Personal exemptions were eliminated. So such that we have a system now where 90% of tax filers do not itemize because the thresholds are now so high that you don't need to. It's up, I believe, I'm sure someone will write in and correct me, but it's up around $27,300 in 2024. Child tax credit, there's a proposal, as I mentioned, to raise that from $2,000 to $5,000. Itemized deductions, as I mentioned, 90% do not itemize. But the point there was to do with state and local taxes. So the SALT limit of $10,000. There's talk actually just on that sub bullet point of possibly lifting that. It's been stuck at 10,000. That hits folks in higher real estate markets, and it's beginning to hit people more broadly, given the rapid increase we've seen in real estate prices in the last couple of years. More and more people are feeling the impact of that $10,000 state and local tax limit that might have otherwise helped their ability to itemize. The state tax exemption, as I mentioned, that's being made permanent, and miscellaneous other changes from the TCJA. Changes to business taxes. What are we seeing? There's a proposal to lower the corporate tax rate from 21 to 15% for companies that produce in the US. Restore the TCJA business tax provisions. This is particularly for business owners. This was known as QBI, qualified business income, where you could get a 20% pass-through for a qualified business income. There was a phase out that applied to that when income exceeded $400,000 for so-called qualified businesses, typically service-based businesses. And then if you were a domestic producer, there was no limit on that. So certainly a concerted strategy to support domestic manufacturing jobs. That's what we're seeing as a common thread amongst the tax policy being proposed here. A continuation of the 100% bonus depreciation. Folks may not understand what that means. Typically, the accounting depreciation standard I was taught when I came through was MACA's, not McDonald's, but the modified accelerated cost recovery system, which is essentially a formulaic approach for depreciating valuable assets over a period of time. Well, now under current law, you can deduct 100% of a particular asset in the first year. So that's really encouraging the purchase of new machinery and equipment, and keeping the US highly productive with the latest equipment. R&D expensing and EBITDA-based interest limitations as well. So those are the changes for business taxes. And heard on the campaign trail was what you see here, and that is once and for all, I'm going to end double taxation on our overseas citizens. Now, the devil's in the detail with that one, because what does that mean exactly? That doesn't mean, to be clear, if you're a US citizen who moves overseas, who retains a retirement account in the US, that suddenly your taxation on that account went away. No, it doesn't, because you're still a US citizen drawing on a US asset. It would simply mean that if you're making income, or essentially you have any non-US related financial transaction that were to occur, say one of the classic gotchas is the sale of a primary residence. which in Australia is unlimited. If you bought your house for $500,000 and 20 years later it's worth $2 million, there's no taxation on your primary residence. The US, you're limited to 250,000 of gain for single and married filing separate filers, and 500,000 for married filing joint filers. And so with mixed nationality or multinationality couples, we can see them getting stung on the US side. Probably the most noticeable or notable effect would be with superannuation, which can really hurt with retirement income planning for dual citizens. So this organization here, the American Citizens Abroad, I'm gonna keep my ear to the ground for what they announce, because this is their whole reason for existence, is seeing the end to this citizenship-based taxation. Okay, what about Social Security? It's funny, so there was a recent proposal, and I think in reading the headline, I misattributed this to Trump, but turns out it's unrelated to Trump. And that is the proposal to remove the windfall elimination provision and government pension offset. That's huge. That's actually the bigger news here for this audience, I think. And that I've mentioned right here. So it's called the Social Security Fairness Act. It actually has nothing to do with Trump. This is coming through under the Biden administration. I don't know the horse trading that occurred for what suddenly brought this to pass, but it's sounding like it's pretty likely that this will go through. It must go through in the current session, so this must be voted on, I believe, in the House by the end of the year. And from what scuttlebutt I read, they have the votes, and it looks like this is likely to go through. Yet again, this is another one of these proposals where it sounds great, and not unlike many other tax-related proposals. They're kind of misconceptions or misnomers in the very name, because the windfall elimination provision is one that applies. It came about because of people in the US who were claiming multiple pensions, and even on an earnings record where they were not paying into Social Security at all. And so it was more to do with double dipping, and now they're eliminating that and the GPO as well. This is actually very good news, and I do not think it's unfair. I think it's removing something that's unfair with regards to expats, and that is, when you apply for your Social Security benefit from Australia, which you can do courtesy of what's called the totalization agreement that the US and Australia have. That's an agreement to do with totalizing Social Security taxes between the two countries. Typically, this Office of Earnings and International Operations, that's the name of the Social Security administration that works out of the Philippines that services Australia, they would ask you what your superannuation balance is, and they would prorate, they would infer a certain income stream from that. They'd say, well, you've got a pension from Australia, and we're going to reduce your Social Security benefit because you've already got this pension. And that was their argument. They were using the windfall elimination provision to count your super as a pension asset to reduce your Social Security. So better outcomes for folks in Australia. Okay. Just read a comment there, so it just took a second. Other changes to Social Security. So eliminating federal taxes. 40 states don't charge taxes on Social Security anyway, but this will be the federal removal of taxes. So about 40% of Social Security recipients pay federal income taxes on their benefits. That's actually a damning statistic, by the way. This is, again, it's not supposed to be a political presentation, but that says something right there about how much people are making, and that Social Security must be their primary source of income, because you don't have any tax if it's under $32,000. Therefore, we can connect a dot there and say 40% of Social Security beneficiaries are married filing joint are making less than 32, and the individuals are making less than 25. So that's a sobering statistic right there. Taxation of Social Security benefits depends on your combined income, not your age. And there's the formula for that right there. And the income thresholds for Social Security benefit taxation are not adjusted for inflation. Yet again, this is one of those things where I think you could make an argument either way. Like I would say, well, if the federal government is going to pay you a pension, then wouldn't it just be more efficient if they didn't tax it at all? If they just paid you less and didn't tax it, then you need fewer staff in the Social Security Administration and need fewer staff in the IRS because they just don't have to assess tax on all of these people in this particular situation. That's not how it works, however, and the way that the Social Security Trust Fund is funded is primarily through payroll taxes on the current generation of workers, but also from, this is another major source, is by hitting the so-called higher income Social Security beneficiaries and taxing their Social Security benefits. Keep in mind, Australian non-resident aliens who are, that's the term used in the US to do with non-Americans, non-American persons, they're hit with a 25.5% withholding tax on Social Security. So I don't know, I haven't read anything about that, but that might go away too if this federal tax goes away. Yet again, continuation of the theme, good for me in the here and now, maybe not so good for me later and decades from now or for my kids. There's research I've got here. I took it out of the presentation, but it shows you how much quicker the Social Security Trust Fund, which was already scheduled, to run out of money in 2033, how much quicker that now happens and how much larger the benefit reduction is as a result of just this change. Stock market and economy. Okay, first we're going to start with an economic health check to see how the recession indicators look. Then get into interest rates. What does the future hold? Look at the tea leaves and see what they'll tell us about the prospect for future interest rates, tariffs, deportations, and inflation. So this is taken from BlackRock in their November market outlook, and this is what they're saying here. So unemployment rate is apparently it's concerning at 4.2%. I don't think that's true at all. I think it's still historically low. It's incredibly low. The Fed has engineered what I think is going to be appreciated as a Goldilocks recovery from this high inflation we had following the pandemic, and for employment to get up to 4.2, that's pretty good. There is talk of a white-collar recession, a white-collar job recession, particularly a middle manager job recession. And that's to do with a cultural change with flatter organization structures that maybe is being enhanced by AI and greater workplace efficiencies. Bank lending standards, they're looking great. So 7.9% there. Industrial production, it's looking very poor. So it would seem that that reshoring industrial production would certainly be an indicator that could use some significant improvement, being on the negative side. Small business optimism, it's just shy of being a concern. Remember that these stats were taken before these polls were taken before the election, so there was a lot of waiting on the sidelines, a lot of angst and concern. So it doesn't surprise me to see or it wouldn't surprise me to see that that's rebounded. And also personal income growth is looking very strong right there, 2.9% year over year. Relative stock market performance. What do we have? So let's look here at the top left-hand table. You see the US, the S&P 500 is the index that we're looking at here. So what has the US done year to date? 28.4%. Really a standout performance, phenomenal return, bested only by Taiwan. And what's interesting when we break down the performance of the US stock market performance, it's predominantly that Magnificent Seven, the AI play, if you will. And if the US is a beneficiary of the AI play, then Taiwan is even more of a beneficiary of that, given the concentration of semiconductor manufacturing that happens in that country, excuse me. But when we look around the rest of the world, we're still seeing some positive numbers, but really nothing that's particularly impressive. All cap world ex-US. So if you remove the US from the index, then the rest of the world is running at 8.5% year to date, 2024. Europe, Australasia, and Far East. Europe ex-UK 3.2%. Well, look at France. France is in trouble, and they've been in the headlines for all the wrong reasons. With the threat, the Marine Le Pen's faction threatening to bring down the government there. So they've been in recession. Germany's on the ropes. They're taking it with their automotive industry. So there's really nothing terribly exciting happening in Europe right now. And Brazil, speaking of being on the ropes, they've been very much going in reverse there. China, if we go back 2023, they've rebounded this year, but last year they were in negative territory. But if we go back and take a 15-year average, I think that's a much more compelling and telling statistic. Brazil, no one's using that other than Trump the other day, who threatened the BRICS countries he threatened them with something. I forget what it was, but if they devalued their currencies, he was going to come after them. But I was going to say, no one uses that acronym BRICS anymore, and that's because the first letter really fell off the page. It was Jim O'Neill, a former economist for Goldman Sachs, who coined BRICS, and who later made the comment that, you know, these are emerging markets, and we're kind of continuing to wait for them to emerge. So Brazil, Russia, they've been sort of sacked from even appearing here. India, they're turning in a decent performance, and China, not so much. That's a 15-year return from China. So paltry when you compare that to the US. The US has really had an historical standout performance post GFC. And if we see that over here when we move to this right-hand table, this is the share of global market capitalization that all of the listed stocks in the world comprise of the total value of all of them. And you can see since 1987, the US share has more than doubled, or has about doubled over that period of time, while Europe, ex-UK, has declined, while, who's this in green, emerging markets have picked up, and Japan has really fallen from grace. That was their 1989 high that, at least on the Nikkei, they only recently surpassed some 35 years later. So the US is really the standout in this market, but it's not without its risks. In fact, this gentleman here, Rashir Sharma, who was an analyst with Morgan Stanley, he's moved over to one of the think tanks. He says this is the mother of all bubbles. The US has never been so overhyped relative to the rest of the world. Now, do keep in mind there are analysts out there who make a living from being perma-bears, Nouriel Roubini being chief amongst them, I might add. But he makes some good points. They always make good points in their counter or their contra arguments here. And really, when we strip out the effect of the Magnificent Seven from the US, you see the returns they actually look a whole lot more like the rest of the world. They don't look quite so spectacular. So there's been a tremendous amount of money that's flowed into these incredible global companies. And they're now riding not the internet wave of the late 1990s, they're now riding this new wave of hysteria to do with AI. That's not to say that there's nothing to the argument. I think AI will change the way things are done from here on. This is a fundamental break. This is a step change in how things are done and what growth patterns will show. But sometimes the euphoria of the initial announcements is excessive. Other risks, with Trump coming in, and who was calling cryptocurrency a fraud previously, now that his son has a crypto exchange, suddenly he's a big believer in it. I'm not. I'm actually a huge bear of cryptocurrency, but again, I'm not paid for my political opinions. But this is more financial, so this is where my opinions are actually considered. So cryptocurrency, is it becoming a systemic risk? I think so. You know, with the amount of money that's now in there, one of the next articles in yesterday's newspaper was to say that it was in The Economist, actually. This week's Economist is talking about how, while global business may be going in reverse, global crime is accelerating on the back of cryptocurrency, synthetic drugs, and cryptographic communications, so encrypted communications. So none of that is good at all. The economy, America's economy is the envy of the world. And in this article, this is taken from yesterday, as you can see right there. So this is how recent this is. Financial Times, yet again, are just pointing out how incredible the performance of the US has been over the past 15 years. And we run the risk with the Trump presidency, certainly with deportations, with lowering of interest rates, with tariffs for sure. We run the risk of overheating this economy, of regenerating inflation, and essentially killing the golden goose. Speaking of inflation, what do we have here? This is a chart from JP Morgan that's showing us the components of inflation going back to 2021. We can see what was a contributor to inflation, namely core goods, has actually gone into reverse. It's now disinflationary, as is energy. That became quite expensive throughout the pandemic, but now looks like that's headed in reverse. And really what I don't see slowing down as a contributor to inflation anytime soon is shelter. I think there's two primary drivers there, one of which is the underproduction of housing that occurred post-GFC. This is a worldwide phenomenon, the lack of credit that occurred there, the foreclosures, they just weren't keeping up with growth. And now the not in my backyard mentality is curbing appropriate and sustainable development levels in major capital cities around the world. The other thing to do with shelter, and this is an original hypothesis, is to do with climate change. And that's when we think of the frequent flooding and extreme weather events that we're seeing all around the world, we're now hearing about major parts of the US simply being uninsurable. I heard this today from clients in California, and I heard it last week from clients in Florida for different reasons, for completely different reasons, flood versus fire. And so I think the only way that you can really deal with shelter and that risk of having your house become encumbered somehow, it would be to build to a higher standard. So build to a level where you can withstand a Category 5 hurricane, or you have some defensive measures against bush or wildfires. So I think that we're going to see inflation on the shelter front for a long time to come. Federal fund, looking at interest rates here, and this is just the federal funds rate and the expectations going forward. So the Federal Open Market Committee, they are saying this is their year-end estimates for 2025. They see it coming in at 3.4, 2.9 by 26 in the long run, 2.9. I don't think, if Trump comes in, that's what he wants to have happen. So lowering interest rates, that's going to stimulate demand, and we run the risk of juicing up inflation again. The market, at least at the time this was taken, which was only in November, was more sanguine about interest rate expectations, and you see that plot right there in the green diamonds right there. So that's what we're expecting, and this leads to a very unusual yield curve where we still have the current. I don't have this slide available right here, but what we're still seeing is an inverted yield curve where the shorter term rates are higher than, or as high actually now as the long-term rates. So it takes a dip in the middle and then comes up with with higher rates at the 20 and 30-year terms. So what does that suggest then for folks sitting on cash? You might consider that these interest rates may not last. How about that? They're likely to decrease from here. Federal debt. Okay, so yet again, this is also from JP Morgan's Guide to the Markets. 2024 federal budget. This is how it looks. So total spending of 6.8 trillion, and it's made up of other net interest that's owing on federal debt already. So that's getting close to 900 billion. Non-defense discretionary, that's where we'll find the I believe that's where the Department of Education exists, is in there. Defense coming in nearly a whopping $1 trillion, just an astonishing sum of money. Social Security and Medicare. So when Elon and his colleague, what was his name, the Republican candidate that the biotech entrepreneur that went along with him, they want to get their Department of Government efficiency going. When you look at this budget and you have the goal of slashing 2 trillion from the budget, well, there's not going to be it's not going to go easily from Social Security, that's for sure. It's not going to go easily from Medicare, that's also for sure. And it's sure as heck not going to come from defense, which leaves us with about what's that, 2.7 trillion between other net interest and non-defense. It's not going to come from interest. Got to pay that. The safest asset there is apparently is a US Treasury bond. So that really just leaves two categories as to where that might come from. But when you look at how the budget is funded, currently we're already running a 28% deficit, borrowing 2 trillion a year to support the current rate of spending. It would seem that some amount of fiscal prudence is going to be necessary. On the right-hand side here, you see the federal deficit and net interest outlays. So there's that 900 billion in net interest outlays right there. If the Tax Cuts and Jobs Act is extended, you can see what that's doing to enhance that deficit. Federal net debt, same thing. Look what it's doing to enhance the deficit. So I am continually reminded when I revisit the campaign highlights that they're good for the here and now, but I just don't feel right as a father and as a citizen supporting things that may imperil. Thank you, Matt. That was it. Yeah, Vivek Ramaswamy. That could imperil future generations or the stability of the US. And here's a great quote from Oliver Wendell Holmes, who says taxes are what you pay for a civilized society. Immigration. There's actually a great webinar taking place. I believe it's this evening. It might have already happened, or it might be on right now, with Chantel, spelled with a Z or a Z, out of New York, where she's talking about more granular changes that are coming through on immigration. But in terms of proposed changes, really immigration, as we all know, is a central campaign issue, with President-elect Trump vowing to take strict action to restrict lawful and unlawful immigration into the US. What did we see? And actually, just before we get on, what did we see last time? And also ending birthright citizenship. That's going to be tough, ending birthright citizenship, because it's written in the Constitution. So you need a constitutional amendment to get rid of that one. That makes me think that he might be serious. He may well believe that he wants to get rid of that, but the actual structural impediments to doing that could be too challenging. So what did we see last time? We saw staffing of embassies that became a skeleton crew, processing time for visa renewals that really extended beyond anything reasonable. I recall a client of mine who was renewing on an E3 and had a job in hand, but it took so long to get it renewed that for fear of overstaying his E3 that was set to expire, he had to return to Australia, do his 2 weeks in quarantine, because this was in late 2020, do his 2 weeks in quarantine, and then sit in an Airbnb for 6 weeks doing nothing, couldn't work because that would have also invalidated the terms of his visa, sitting there basically just catching up on Netflix and doing a whole lot of nothing for that time until his visa was renewed. And Matt Conley says you can't change the Constitution, and that's from the Aussie comedian Jim Jeffries. Okay, so that's what we're seeing here. So it doesn't seem like there's been anything concrete proposed as far as I could find. It's more just a general sentiment against immigration. which is very interesting when we look at the spouses of the president, the vice president, to see that they're suddenly so anti-immigrant. But that is just a comment by the side. So where can you learn more? There's my website right there. If you feel like you might do well to speak with me, then please click on the Get Started. If you want to find any of our key financial data sheets, white papers, flowcharts, webinars, they're posted here in the Knowledge Center. And next month, in air quotes, which because it's only in 2 weeks, because I love doing these presentations so much, is global tax planning for maximizing your savings, reducing your tax bill in 2024. So year-end tax strategies for US-Aussie expats, December 17th, 2 weeks, same time, same place. That's a wrap, folks. I will be here for a few minutes, just seeing if anything comes through. No doubt, despite saying that I can't see the Q&A, people will still have written into the Q&A. So I'm just going to minimize my screen and see if anything actually does show up. Nope, not so far. Let's see. So no open questions. There's a chat here. Maybe people are just gobsmacked. Jana or Jana, thank you very much. Appreciate that. Martin, same to you and to Astrid. Thank you. And Soto, Mark, you're very welcome. Oh, Peter, there is one coming. I like when people flag their questions. There's one. Okay, just loading. I'm not seeing it yet. Thank you, Nancy. Appreciate that. They get better and better. I do try. Ruth writes, "Hi, Ruth. Hope you're well. Do you see a financial impact if there's a big exodus of immigrants?" Absolutely, I do. I think that's actually very easy to answer and hopefully uncontroversial. And here's why, is because if you are a legal immigrant into the US, you are already better than the quote unquote average, because for practically every immigrant visa type, you have to meet certain conditions. And so you're entering in a large pool of high functioning adults that are making valuable contributions to the workforce. Thus, if they leave, that's going to hurt as well. One of the great strengths of the US economy is the demographic profile of the US, not from native-born people, because of the immigration. This is what demographers continually point to as a strength of the US, is that it is a beacon, it is a place people want to go to. And that is in stark contrast to other countries where people don't want to go to, namely like China, for instance. I mean that only in terms of, if you look at total number of immigration in versus out, people want to be out, they don't want to be moving in. And what are they looking at? They're looking at a demographic deficit given the one-child policy and how that's beginning to catch up to their working age population and the impact that it's making on their labor dependency ratio for paying pensions. Peter writes, with the possible change of the US tax return requirements on US citizens and long-term green card holders, could this mean it would be more favorable to become a US citizen when moving to Australia instead of going through the exit tax issues? You know, I haven't fully thought that through, Peter. That's a very good question. And this came up as recently as earlier this evening when speaking to a brand new client. And I think it depends on the level of pain. Leslie just saw your point. I think it depends on the level of pain that you would suffer in remaining as a US asset. So we know about the Hart Act, the 3 tests, right? The income test, average 5-year tax liability was in excess of $200,000 US over the past 5 years. That's tax liability, federal tax liability, not income. Did you have a global net worth more than $2 million? Or 3, are you compliant with your state and federal taxes? So assuming you're well above that, it's going to be tricky and expensive to plan your way around it and get under 2 million, because there's some nefarious consequences to the Hart Act for folks that have kids that are also US citizens. And that is there's a sleeper provision where kids get hit with, or I should say, the heirs of a covered expat who are US citizens, they immediately get hit with a 40% inheritance tax. So that is very unpleasant indeed. If, however, your situation was different and you could easily gift or shift assets around to get under the 2 million, then I would say it probably does make a lot of sense, particularly thinking of situations where clients have accumulated large retirement account balances. They're either going to have to pay, federal taxes on that entire balance, even if they're living in Australia, they're paying US taxes on that balance because they remain US tax residents, or they're going to have to go, if they get out of the US system, then they could take a tax treaty position, Article 18.1, that says that only the country of residence is able to tax it. And if that's the case, then you'd be much better off to take advantage of that. So much of this is unknown, just so you know, and full disclosure, Peter, as I was saying that, I was thinking to myself, oh, well, maybe that isn't quite true, because what I just said, I could think of an argument that where it would apply and where it wouldn't apply, and we'll just have to see. The way the tax treaties are written, all US tax treaties include a clause called the savings clause, and what it says is we're going to pretend as if the treaty does not apply any benefits to US citizens. So if they removed that clause, then I could imagine you being a US citizen, withdrawing your IRA or 401k and not having to pay US taxes on that, because the way the treaty is written is only the source country has taxing rights on it. And it's only through virtue of the savings clause that the US gets to tax it. We're just going to have to wait and see. Maybe in 12 months from now, I'll do a part 2 to this webinar and see what came to pass, because a lot of people's planning for exiting really does turn on this. And you're most welcome. Do you have a timing? No, absolutely. Oh, sorry. Yes, I did. I said end of the year. End of the year. It's no later. It either will or will not happen in the current session by the end of the year, Michael. Peter, I agree. This needs more in-depth thought. Okay. Leslie, she's got her word of the year here. And Ruth, again, I was wondering more about the deportation of illegal immigrants who tend to do the jobs. Yeah, that's right. Who are less inclined to do. That's right. Yeah, I'm not here making any judgment of those people. I said that there would be terrible personal cost to them, and then terrible economic cost to the folks that remain in the US. All right, Elva, when is the next webinar? 2 weeks, Elva, 2 weeks. So that's the 17th. I think that's everything. The question rate, the comment rate has slowed down. So thank you all for your attendance here tonight. And you know what? If you know someone that my firm might be able to help, then please don't keep me a secret. That's all I ask. So thank you very much. Have a wonderful rest of your evening. Good night.